What's up, everyone? It's Caddy with Money Investing. So in this video, wanted to break down exactly what Janet Yellen pretty much talked about in her yesterday's testimony in front of the Senate. We had both Jerome Powell and Janet Yellen talking at the same time, so there was some expectations. In other words, there were some estimates that the markets pretty much sold off, not only because of Jerome Powell and the fact that he was saying that there's no rate cuts planned out for 2023 or 2024, and they are going to be sort of pulling back on the rate hikes, but they are still expecting to remain sufficiently restricted with respect to rate cuts. But on another end of the world, we did have, of course, Janet Yellen talking in front of the Senate and talking about the insurance policies and the blanket insurance as well. There were some tweets from Bill Ackman and Senator John Kennedy absolutely ripping apart the Federal Reserve and the Treasury Department, which I wanted to break down in this video as well. So hope you guys enjoy it. Find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. And the link to our Discord and Patreon is going to be down below if you're interested in joining us. And of course, getting access to all the buy and sell alerts, options alerts, trade ideas, and of course, all the private videos, tutorials, lectures, all the benefits. And there is a 16% annual discount that does expire at the end of this month. So if you want to take advantage of that, now is the time. Link's going to be down below. So first things first, Jerome Powell, I've already broken it down in a separate video. We already went over exactly what he talked about, right? Rate hikes are not in the picture, at least not in the base case assumptions, and they are going to be doing some additional firming with respect to interest rates. They're not going to be doing some ongoing increases or changing the language a little bit, and they are pivoting slightly, but they are still going to be supporting the banks, and of course in a way that's feasible for the Federal Reserve through bridge loans to the FDIC, and of course providing lending activity in respect to with the return to the collateral the banks are going to provide to the Federal Reserve as well through the discount window, and of course other programs such as the Bank Term Funding Program and the US dollar swap lines to other central banks around the world. We got a lot of updates with respect to inflation expectations. They are expecting inflation to moderate down a little bit later this year, of course, or early next year. However, they do still expect inflation to be stubborn enough to be more challenging, and we still do have a long way to go for inflation. And Jerome Powell once again finally saying that if we need to do more, we will do more. Now, with respect to Janet Yellen, now, Treasury Secretary Janet Yellen, and she's been talking with everything that's been going on with the banking crisis, on Wednesday pretty much said, and I quote, "The blanket deposit insurance isn't something that we are considering at the moment." She testified before the Senate Appropriations Subcommittee, and Yellen was asked about reports that officials are studying a way to expand the Federal Deposit Insurance Corporation to cover all deposits, to which she says, "This is not something we have looked at, and it's not something that we are considering." So blanket insurance, think of it as like a big blanket, right? Blanket meaning covering everything. And this is kind of like a backpedaling from Janet Yellen, because in the past, she has talked about, depositors being safe. I actually did a video one day ago talking about this exact same thing. This right here was the video where I pretty much mentioned Janet Yellen's prepared remarks, and I mentioned damage control and the fact that she is backpedaling a little bit on this idea that not all uninsured deposits are going to be covered because of the fact that it's going to obviously require a lot of debate. It's going to require a lot of conversations, with Congress, with the Senate, with the president, and there's just a lot of things that actually go into it. So of course there were comments made from Janet Yellen at the time to stabilize the market, to restore confidence, but now she's backpedaling a little bit in terms of damage control in order to make sure the market and the economy knows that not all uninsured deposits are actually going to be covered. Now, asked about raising the limit, Yellen replied that the focus should be on improving the public's confidence and that the banking system is sound, and that the $250,000 level was something, quote, "we can debate in the days ahead." So that is something, those are the couple key takeaways that I wanted to bring up that I think were very interesting, but the market definitely did sell off, and we are still pushing higher in the futures right now. Pre-market, we're gapping up a little bit, but not by a whole lot. So Senator John Kennedy, that was the highlight of this meeting, because he was about as brutal as somebody can get with respect to the fiscal deficit, the national debt, and taxes. So first thing he talks about is that the president's budget proposal has been increased by $500 billion. Earlier it was $6.4 trillion, and now it's been increased to $6.9 trillion. This is the budget for 2024. And it's been increased by $500 billion. And Yellen also mentioned that president's proposal will also increase new taxes by $4.7 trillion That's how much additional taxes there are going to be. And the debt will increase from $32.7 trillion at the close of this year to over $51 trillion by 2033. In the next 10 years, the debt is expected to grow from 32.7 trillion to over $51 trillion. So if you do the math here, 51 divided by 32.7, that is a growth of 55, almost 56% growth in the debt levels for the national debt, for the gross debt of the United States. So pretty substantial amount. And that, what Janet Yellen says in that meeting, in that actual press conference, if you go back and watch it, she says that this debt increase will actually be a significant improvement. And if this budget was not proposed, things would have been much worse. Another thing that Senator John Kennedy mentioned, which I think was very interesting, was the idea the Federal Reserve actually did issue a warning to Silicon Valley Bank back in 2019. So 4 years ago, they actually issued a warning letting Silicon Valley Bank know that your risk management is not up to the standards and they need to improve it. Well, guess what happened? There was no enforcement or no follow-up with that. And 4 years later, Silicon Valley Bank pretty much collapsed, bringing down all the depositors with it, and of course, creating contagion in the financial services industry. There was also private bankers, analysts, and short sellers 5 months ago even suggesting Silicon Valley banks has had a huge risk of failure because of the improper or not so up to standards risk management strategies, and it kind of suggested to improve on that, but they never did. And once again, those were some of the warnings that we did already have prior to Silicon Valley Bank failing. Another thing which Senator John Kennedy mentioned is the fact that the stress test the Federal Reserve does with respect to the Financial Stability Board, they don't account for interest rate risk. That is absolutely mind-boggling if you think about it. They account for credit risk, liquidity risk, and a default risk, counterparty risk, but they don't account for interest rate risk. So even if Silicon Valley Bank was part of the stress test, it would have not been caught because of the lack of interest rate risk assessment. And that is crazy because that's literally the bread and butter of what banks do. They borrow from depositors and they lend it out. They invest in treasuries and mortgage-backed securities and other securities. And they are very susceptible to where interest rates go. If interest rates go higher, the market value of their assets on the balance sheet drop. And that is literally just, Econ 101. And they don't look at interest rate risk whatsoever. So that is absolutely crazy. I just, thought of mentioning that. And this right here was a tweet from Bill Ackman, which I think is definitely worth looking into because this could accelerate a little bit of those bank runs moving forward because of the comments from Secretary Yellen. So yesterday, he says, and I quote, "Yesterday, Secretary Yellen made reassuring comments that led the market and depositors to believe that all deposits were now implicitly guaranteed. That, coupled with the leak suggesting that U.S. Treasury, FDIC, and Secretary Yellen were looking for a way to guarantee all deposits, reassured the banking sector and depositors." And this is exactly, when I posted my video. So one day ago, I posted that kind of Secretary Yellen kind of backpedaling on her own, comments. And again, you'll notice he says, "This afternoon, Secretary Yellen walked back yesterday's implicit support for small banks and depositors while making it explicit that system-wide deposit guarantees were not being considered. We have gone from implicit support for depositors to explicit statement today from Secretary Yellen that no guarantee is being considered, with rates now being raised to 5%. And 5% is a threshold that makes bank deposits that much less attractive. I would be surprised if deposit outflows don't accelerate effective immediately." That last line is very important, pretty much suggesting that it is a possibility that we do see some acceleration in deposit outflows for these community and smaller banks. Community banks, again, if that happens, we are going to see more runs. And every single bank is vulnerable to a run. If there is a bank run for any bank, doesn't matter what bank it is going to be at a threat, it is going to be vulnerable because the assets they hold are so underwater, the market value is so far below their book value, they're not going to be able to meet the demands of their depositors in terms of liquidity. So that is a problem. A temporary system-wide deposit guarantee is needed to stop the bleeding. The longer the uncertainty continues, the more permanent the damage is to the smaller banks, and the more difficult it'll be to bring their customers back. So I do think there's definitely some truth to these tweets because Secretary Yellen suggesting no blanket insurance, and once again, backpedaling a little bit and saying there's not going to be, is not being considered, is definitely worrisome. And then you've got Jerome Powell raising rates 25 basis points, suggesting that if inflation keeps on coming in hotter, rates can even go higher and rate cuts are out of the question for 2024. So we got to brace ourselves. Market might be higher today. Markets could be short term, very, very bullish, no doubt, with all the QE that's going to be on the potential future here. But we have to still be paying attention to what's going on a more economic, landscape and an economic backdrop, pretty much. Because if there's more runs on community banks and smaller banks, the problem is far from over. So hope you guys enjoyed this video. Let me know down in the comment section below, what do you think? As always, if you enjoyed this video, found it helpful, make sure that you drop a like, subscribe to the channel. Link to our Discord and Patreon is going to be down below. So always happy investing. I'll see you all in the next video.